good afternoon, and good evening to all. Myself Vaibhav. In today's session of automated trading, we are continuing to work with Williams R setup, in which we are trying to utilize the overbought and oversold scenarios with the trend. Not We are not going for contra trades. We are simply trying to buy when it is overbought, and we are trying to sell when it is already oversold. But there is a caveat, and it is that it is only during the initial time, and the time frame is also pretty on the lower time frame of 10 minutes only. So we will see how it is going to work on the charts pretty soon. This is a Williams R indicator. I hope you are well familiar with the technicalities of it. And then comes the ATR. Before we get started, this is a standard disclaimer. Here I would like to remind you of the session is simply for the tutorial purpose, and no claim is being made regarding the profitability or otherwise of the algorithms which we will be developing during the session. Suppose if you want to use any of it, I would suggest that you do extensive trial runs and also allow it to run for sufficient enough time on the demo accounts to get a clear idea of the efficiency of these algorithms. And of course, nothing in the webinar is to be constructed as an advice to trade or for any particular setup. With that, we get back to the business. First, we will go to the charting to see what has been the idea on which we have been working so far. So basically, we are looking for the buy trade when the Williams R goes above this minus 20 level, and the sell trade when it is below minus 80. And for that, we are utilizing the Williams R indicator on the 10 minutes with the shift 3. So we are not taking current value into the calculation. We are relying on the value half an hour back, and then we go back 2 hours in time, and we utilize shift 12 on the Williams R and see if at that point in time the Williams R was below minus 80. Suppose if we are buying somewhere here, let us assume for a moment that our trading conditions are going to be fulfilled somewhere around 18 GMT. Then we go back in time to 16 GMT and see if the at 16 GMT if it was in a oversold scenario. So basically we are looking at instances when the momentum turns from being in oversold to overbought on the 10 minutes. And for the sell trade, we look in the inverse fashion when the momentum turns from being in the overbought scenario to in the oversold scenario, and then we kind of play with the trend. And also we don't go with a fixed target or stop loss. We simply keep it dynamic, and we allow the volatility of the recent few hours to help us define. We are utilizing ATR on the 14 candle period of 10 minutes, so we are actually looking at the data of last 114 minutes, and that is just little less than 2.5 hours. So we will rely on the recent volatility, and then we will trade accordingly. So let us get back to our setup, what we have done so far, and then we will start to build the buy side and the sell side. Of course, we will need to do some calculations as well. So the setup so far has been that we have done these instrument subscription. We got the Euro USD, then we defined the position amount at 0. Williams R, as I said on the charting, we are utilizing shift 3 and shift 12 on the 10 minutes, and we got the historical candles of 10 minutes each. Here also shift 1 and shift 2. Then we got the historical candles, shift 1 and shift 2 for so I think here we overlooked in yesterday's session. uh, Yes, we actually, it should be 10 seconds, so we have overlooked this, and I think in hurry I have forgot to change the time frame, so pardon me for that. We will do it today. We are utilizing the 10 seconds candle for pinpointing the entry and exit points, and we now need to look at the historical candle data. Okay, so it looks good, and then we take into account the ATR value shift 1, and then we did this calculation for the buy and the sell entry points. So we are done so far. We will need to do the calculations for the stop loss and target price as well. But now we start to build on the buy side, and then as we reach the market open or the pending open scenario, we will do the calculations there. This time around, we will go for stop means I will explain to you with the block only. So let me get the pending open order trading. So see here, if suppose if we are going in for a buy trade, in most of the algorithms which we have developed, we have gone in with the buy limit order. So in buy limit order, the order is placed for a buy below the current price, but now here we are not actually going to place the order below the current price. We will be placing it above it. So you have to do a buy stop order, not the limit order. So this time around we will be utilizing the buy stop. So it will be where it is, okay, and it will be placed higher than the current value, the market value. So we will get it back when we need. Now we start to build what we have to do to get the configuration right. We will leave some space here as we will need to do further calculation. So we leave one row empty and we will add as and when the need arises. So we get the multiple action block and multiple action, let it place somewhere here. We will not joining the flow just yet. We are waiting for everything to get set, and let us get a couple of if blocks. Okay, we will need to go towards the Williams R values. We are looking at the Williams R values first, and then the price action of the 10 minutes candles. So we are at least going to need 3 or 4 if blocks. So let it be, and then we get the Williams value. Now as I said, while buying we look at the Williams value of the shift 3, and it should be above -20 here on the chart. So it should be above -20. Okay, we put it here -20. Okay, we got it. Now we link this to this greater. Keep this in mind. We should get the conditions right, otherwise our algorithm will work or might work in exactly the opposite fashion of what we intended to do. And is greater, yes, it is greater. Now again we go back in time to Williams R value on the shift 12 candle, and that should have been below, that is less than -80. So it was in a oversold scenario -80. We join the dots here, and We also need to look at the closing and the opening levels of the prior candles. So the last candle should have closed in red and the prior candle should have closed in green, and also the last candle's closing level. So let me take an example. For that matter, if we let us assume that this is the last candle and here our trading conditions are fulfilled, then its closing level should be even below prior candle's opening level. So that is what we are looking at. And suppose if you are looking for a sell trade, then this kind of scenario should play out. The prior candle closed in red, that is with losses, and then the next candle closed with gains, and then we place the order for sale somewhere lower. We are utilizing 30% of the 10 minutes candles ATR, so we will add it once the price starts to fall below the closing level. For that we are going to utilize the 10 seconds candle. So whenever it will close below this, we will immediately deduct 30% of the ATR from the last tick and we will place the order, which is going to stay valid for 10-12 minutes. We will not let it remain valid for longer time. We will simply keep it for 10-15 minutes. That should be good enough. So now let us take the data for the candle 18 and candle 19. So first we will take candle 18's data, and for that auto created variable. Okay, we got the candle 18, and the candle 18's close should be below the candle 18's open. So we do this and we get it should be close, should be less than the open. And then we look at the candle 19's opening and closing levels. And here also the candle 19's close should be greater than the candle open. So earlier the last candle's closing level was needed to be less than the opening level, and the candle prior to the last candle, its closing level should have been greater than the opening level. And now we get another block. So this time what we are going to do is we need to compare the candle 18's closing levels. So we get the candle 18's close to the candle 19's open, and we need the candle 18's closing level to be less than candle 19's open. Okay, so we join this thing here. Candle close should have been greater than the opening price. All right, and then we take some other blocks, and the requirement is candle 18's close should be below the candle 19's open. Okay, so far so good. Now let us take these blocks where they belong, and then we will do further conditionals. we join this here. We have set the requirement for the Williams chart and the historical candles. Now we will need to look at the 10 seconds historical candles. So we go and compare the candle 20 and candle 21's value to the candle 18's closing levels. So for that we are going to need 2 E blocks. We get one more and then we will be sorry, pardon me. Then we will be in a position to bring in the pending open and define its parameters. So we look at the candle 20 and 21's closing levels, and as I said, candle 18's closing levels as well. Now let us take the candle 19's close. No, not candle 19's, candle 21, and candle 21's closing level should have been less than the candle 18's closing level. Yes, yes, it is 10 minutes. These are 10 seconds for immediate price execution for defining the entry and the exit points. Okay, uh, so we got this candle 21's closing level and it should have been less than the candle 18. So we go to this candle 18's closing level and we compare it, and it should have been less. So the first input is less than the second input. Now comes candle 21's closing level needs to be compared. So we take the candle 20 closing level, candle 20 is close, and candle 20 is close will be compared to the candle 18 close. So here we have defined this. Now is the time to bring in the pending open on the buy side. So let us see what kind of calculations we will need to do. We got to use the pending open block now, and the candle 20 is close should be greater than the candle 18 is close. Okay, we got it right. Yes. by stop. Yes, then we need to take these blocks. Okay, we will set this. So we have defined the necessary conditions which needs to be in place before the algorithm can execute the trade. Now we need to use the buy entry point as our price for the order execution. So we go here and we see the ATR range pips which we have added to the last tick ask, and that is our result, and the variable type is double, so it will match. Okay, instrument remains the same, trade amount let us keep it fixed at 0.1 million. Depending on the equity in your account, it can be 1 million, it can be 0.01 million. Either way, you should try to minimize your risk. Slippage at 2 pips. Now comes the question of defining the order validity time and then the stop loss and the take profit. So we will define the order validity time first. For that we are going to need to bring in the calculation expression, and I think since we are working with a very short term time frame, order validity of 12 minutes, which is like 1/5 of the hour, should be good enough. So we will take 1/5 of an hour, that is 12 minutes. Our order will remain valid, and once the time passes it will get cancelled. Now we need to bring in the last tick time, and it is on tick, last tick time, and then we have to create a fresh variable. It will be of type double. Let us name it OV, order validity, and there are 3.6 million ticks in an hour, so we need to get the zeros right. Yes, I hope I got it right. You can point it out if you see anything missing. So we take this, and since we are utilizing only 1/5 of an hour, I think third variable can be defined as 6, and we divide it, so it will be like time divisor or time distribution, and it will be 6. You can even keep it 5 minutes, you can keep it half an hour, so it is up up to you. Suppose if you want to change, you simply have to change this factor and the calculation will be different. It's pretty easy and pretty simple. So we do this calculation of a1 plus a2 divided by a3, and now we have to do the type conversion, and the type conversion is for this long type we create a fresh variable order validity time. Okay, yes, and we put this here. Now we have defined the entry point, the amount, the slippage. We need to do two more calculations, and yes, we have some time. We just have a couple of minutes left, so let us do the calculation for. So I think we won't be able to finish fully. So this calculation for the stop loss and the take profit, we will do it tomorrow. For the time being, we keep it as it is with the default values, and when we get back tomorrow for continuing to work on the sales side, then we will define the stop loss and the take profit, and we will keep it dynamic. So we will simply multiply any given range or not any given range, the ATR with a desired variable, and then we will get the dynamic stop loss and the target price as we have done in last couple of algorithms as well. So guys, thank you all for joining in. See you tomorrow. Goodbye.